Good morning and welcome to Teachers Retirement System Investment Meeting. Today is October 3rd, one of my favorite days, 2019. Mr. McTeague, would you like to call the roll?
Thank you, Madam Chair. John Adler.
I'm here.
Thomas Brown.
Here.
Natalie Green-Giles.
Here.
David Kuzansky.
Present.
Russell Buckley.
Here.
Deborah Penny.
Here.
And Susanna Vickers.
Here.
We have a
Okay, thank you. We'll start with the passport funds performance review. Robin, will you start that, or Mike?
Yes, Mike will. Yes.
Good morning, everyone.
Good morning.
So, okay. Everyone should have the August flash report. And so we did already cover off what the markets did back last month when we met for the month of August. But as you'll recall, the U.S. was down 2% during August. We saw a lot more volatility. We saw the same type of volatility abroad. The global developed equity markets, all told, were down about 2.5%. And then in emerging markets, there we saw the down market of about 2%. So markets sold off during August. We saw the U.S. 10-year Treasury fall about 50 basis points, which was a pretty big move. We're going to talk a little bit more about fixed income broadly, but that obviously drove the absolute returns for the funds, the passport funds, during the month of August. And you can see the diversified equity fund with assets of about $15 billion. That fund was down a little bit more than the U.S. equity market, down about 2.4%, which was also lagging the hybrid benchmark, which was down about 2%. One of the things worth highlighting is the defensive strategies composite did provide some downside protection during the month. It captured about 50% of the down market in the U.S., and that was down about 1.1%. And then on the actively managed composite, you can see there's some relative underperformance by the active managers in the U.S. That composite was down 4.3% as a whole versus the broad U.S. at down 2%. And then the international equity composite lagged its composite benchmark by about 0.25%, down about 2.7%. One of the things that Robin and I were talking about earlier jumps off the page is if you look at the calendar year returns through August, you can see the diversified equity fund has a really strong absolute return of about positive 16%, 15.6%. And if you look at what just to the right, what the numbers are for the trailing 12 months, that goes to show you just how poor the returns were in the markets for the second half of last year, and in particular the fourth quarter. It really is stark to see a essentially 0% return for the last 12 months, knowing that the last 8 months you've gotten about 16% from the markets. It's really remarkable, and speaks to the volatility we saw in the fourth quarter last year. If there's no questions on diversified equity fund, which we're going to talk about again later in the agenda, maybe we could turn to the balanced fund. You can see there assets of about $400 million at the end of the month. The return for the month of August was essentially flat. So again, down month for equities, but that was offset by positive returns in fixed income markets for that fund. And that fund year to date is up about 7%. The international equity fund with assets of $161 million. I noted earlier the international composite down about 2.75% for the month. Year to date, that fund is up about 9.8%. The inflation protection fund, it was a modest positive return of about just shy of 0.5%. Year to date, that fund is up 8%. And then the socially responsive equity fund with assets of about $233 million. That fund was down 2.5%. It lagged the S&P by about 1% for the month, and year to date, that fund has returned about 13.5% versus the S&P at about 18%. Yes, that's right. There's previously discussed changes that occurred since these numbers were rounded out. So I'll see if there's any questions there. Okay, great. The next page you should have is a preliminary report through the end of September. There's a few highlights here. So what we saw was Markets basically came back from the returns we saw in August. So in the U.S. was up about just shy of 2%, roughly 1.8% across large cap and small cap. That brought the calendar year return for the U.S. back to just over 20%. The benchmark for developed markets abroad is the MSCI EP index. You can see that was up about 3% for the month, and their broad developed markets are just behind the U.S., up about 13%. And then the emerging markets proxy was up about 2% for the month of September. The label there says custom MSCI emerging markets index. That's actually the broad MSCI emerging markets index beginning September 1. So again, a 2% return there. Calendar year to date, the experience of your custom benchmark, which included changes beginning September 1st, the experience there is about 6.5% calendar year to date. So we've linked those returns up. The underlying strategy for the inflation fund, that was up about 50 basis points for the month, calendar year to date, up over 8.7%. And for the socially responsive fund, the underlying strategy there, up about 2.8% during September, with a year-to-date return of about 17%. One of the other things, just to note, we've talked on and off about the dynamic between value and growth stocks in the U.S., and September was the first month in a while where we saw a very notable shift. You'll recall growth had outperformed value quite significantly over recent years, and in the month of September alone, the Russell 1000 Growth Index was roughly flat for the month, and the Value Index was up about 3.5%. So we saw the deviation, if you will, in the other direction. It's only 1 month, but we'll see if that persists at all. So if there's no questions there, we could turn to the next item.
Just to highlight what Mike was just referring to, if you look at the broad U.S. equity value index, which is the Russell 3000 Value Index, for the past 5 years, it's had an average annual return of 6.5%. If you look at the broad U.S. Growth Index, the Russell 3000 Growth Index, for the same period of time, 5 years ending August, that's double that. It's up over 12.5%. So there's been this extraordinary spread between growth and value that's persisted for a long time. And we'll be talking a little bit more about that in the executive session. So
If there's no other questions, we'll go to the next item.
So the next item is a discussion of the role of fixed income in the pension portfolio, and that discussion is going to be led by our colleague Joe Nancock, who you've met in the past. Yes, please sit down here. But folks from BAM are certainly going to participate in this discussion because this is intended to provide some context and background for all of the asset allocation discussions that will be had over the coming months. As you know, we and the other consultants as well have been collaborating with the BAM team to think about capital market assumptions, to think about asset classes, and to start the process of developing some recommendations for the board to consider. And the last time around, 2016, that we did this, fixed income, and in particular the duration of the fixed income composite, was a very significant topic. There were significant changes made to the fixed income program as a result of that study. And we thought prior to considering detailed recommendations in the coming months, it might be useful to revisit this topic because it's not always an intuitive topic, and it's fairly complex, and it's very important. So this is not a recommendation. This is really to provide some background and context for the coming discussions about asset allocation for the teacher's pension. So Joe's going to lead this, as I said, and we encourage the folks from BAM, Miles,
We've had
Mike.
many discussions over the last 3-4 years on this topic, and not only with the teachers' retirement system, but and the controller's office and the investment team, but also all of our clients on fixed income portfolios and how to utilize fixed income in a diversified portfolio, which for most of our clients does include a significant allocation to equities, which is true of your pension fund as well. I think Robin's covered most of what's on page 2, but I think the point I wanted to make was that with the fixed income markets as they are, and the variety of types of fixed income securities and sectors in the fixed income market, our clients have recognized with our help and also with information and advice from others in the industry that it's not required to invest in the market as the indexes are constituted. You can choose to whatever duration you want in a portfolio. You can choose whatever amount of credit or mortgages or treasuries that suits the needs of the particular fund that you're managing. And more we've looked at customizing fixed income allocations and portfolios, as we have for you in 2016 in particular, but even before then, to best meet the needs of the pension fund. So I think that's an ongoing discussion, and it's something that's worth examining each time that we look at asset allocation. I think for most of our clients, the equity markets, the indexes serve as a very good proxy for what you want to invest in. The markets are pretty efficient, and the level of indexing you do is a representation of that. But in fixed income, we generally try to customize mandates to meet the needs of the fund. If you turn to page 3 for a minute, and again, I'll just reiterate what Robin said. Please jump in with questions or comments along the way. The way we think of, again, with a plan like yours, which is, we say, about 2/3 invested in equity-linked or equity-like securities. It could be public equities, it could be private investments, but they're all tied to either corporations, profits, revenues, economic growth. They generally do well when the economy is doing well, whether it's in the U.S. or outside the U.S., and they tend to do less well when the economy's slow, or we go into recession. 2008, 2009 is the most recent example of that. We've been through a prolonged period of recovery. And what's interesting about fixed income markets and interest rates is they generally are, and I'm not reading from this page because you can do that yourselves, but they generally serve as a forecast for future economic growth in inflation and interest rates. So if we think about it that way, well, the higher interest rates are, generally the more positive the markets are about future economic growth and activity. And the lower they are, that serves as a barometer for maybe future slower economic growth. And it may be driven by either our central bank or other central banks' intervention and trying to prop up either the financial markets, which is not a written, stated objective of theirs, but it has certainly become one more that's more of a focus of theirs, or just continuing to promote economic activity and growth, as long as inflation is not a worry. So we think of 3 risks systematically through time that the equity markets can be exposed to. It can be economic, I've already talked about that. It can be geopolitical, it can be technical. And any of those 3 risks, as they've manifested over time, generally, as the risks present themselves, interest rates fall. Generally, we don't want to say it's 100% proof positive, but it is generally the case that if these risks, it could be, think about the events that we've lived through in the last 10, 20 years. We already talked about, I think a few minutes ago, the tech bubble bursting in the early 2000s, financial crisis, 08, 09, certainly 9/11 was another one. All of these events corresponded with interest rates falling. But we've only seen in the last few days, interest rates have backed up about from their low of below 150 basis points in the 10-year Treasury to about 180. They've come down in the last few days with the equity market selling off. It's not an accident that economic numbers have come in below expectations. Rates have fallen in expectation that either the Fed's going to ease a couple more times this year, or we're just going to see a slowdown in economic activity in the U.S. and abroad. So I think it's important. We think we're going to look at a bunch of statistics which we think bear out some of these fundamental linkages between interest rates, the bond market, and equity markets. but for us, it always comes back to what are those fundamental linkages between bond markets and equity markets, which drive our belief about the role that fixed income might play or should play in a portfolio. And let's see if the statistics actually bear out what we believe. We think all of these objectives are potential objectives for clients to have for fixed income portfolios when they invest significantly in equities. Your portfolio has done this for you over a long period of time. Certainly in the wake of falling interest rates for a long period of time, fixed income markets have benefited from that. Bond yields fall, prices rise, and your portfolio is an example of that, certainly. Any questions on that before we go into some of the numbers which back up some of the? Does that make sense? Okay. So and bear in mind that when we had this discussion 3 years ago, now more than 3 years ago, I guess it seems like only a couple of weeks ago, but I don't think we were. And Michael and Miles could attest to this. I don't think we were necessarily in the majority of the consultants advising the controller's office on asset allocation. We were, and actually page 5 is a good page to look at. We can come back to 4 if we want to, but at the time, if we were looking only at the chart on the top of page 5, which we were actually back then, we didn't see 17 or 18 at the time, but we certainly saw the 2016 or something approximated the 2016 yield curve. And at the time, I remember when we talked about long treasuries, so when you extend duration, which you did, you're taking more interest rate risk. And we thought that was a good diversifier in a diversified portfolio with equity exposure. But what can happen is if you invest when rates are very low and rates rise, you suffer price declines on the heels of that. And everyone in the room was about equally certain that rates were definitely going to rise from 2016 forward. And we're all very certain. It was not only equally, but very certain as well. And I think we agreed with the majority in that room, which was, so we agreed that it was the deck was stacked with it being more likely that rates would rise.
Oh, sure, here, take mine.
It was more likely rates would rise from that point forward. They were at artificially low levels. They were at historically low levels. Any way you looked at it, they looked low. But we also said at the same time what I was just saying a minute ago, which is, well, what does the environment look like if rates fall, and what would it look like for equity markets? And we said probably, not definitely, that if rates fell, economy would be slowing, the Fed would be easing and trying to intervene and promote economic activity, stabilize financial markets. And at the end of 2018, last year, that's exactly what happened. There were concerns about a number of global issues, slowing in Europe and their inability to grow for many years. Japan not growing for close to 3 decades. U.S.-China trade talks, and no real deal on the horizon. And with all of these things overhanging economic growth and activity, the Fed pivoted and changed their position from tightening, raising rates, to easing, lowering rates. And they telegraphed that they were going to ease, and actually the market, on a dime, turned and expected them to ease 3 to 4 times this year. They've already eased twice, and we think that there's a chance that they maybe cut 1 or 2 more times this year, and that's what the market's forecasting. And now that certainly helped. It helped equity markets in the short term, but it corresponded with an environment where there were more concerns about economic growth and corporate profits, and that can weigh on equity markets. And at some point, what the Fed can do to prop up markets and promote economic growth, they'll have a limit to what they can do. Certainly, they can't go below. Well, I think, we used to say they can't go below 0. What's interesting on this page, also at the bottom half of page 5, is we just have a sample of government bond, 10-year government bond yields outside the U.S. So people say today, even with the U.S. 10-year at 1.6, I looked as of last night. And again, that's down from 180. It was down to below 150, went up to 180, now down to 160 again. That people think it can't fall from here. Well, look at what's going on in, take your market, Germany, Japan, UK, Italy, and by the way, we don't have Switzerland on this chart, but the Swiss yield curve out to 50 years is negative. So you have the pleasure of lending the Swiss government money for 50 years and getting paid and paying them, essentially, is what it amounts to. So,
Joe, I'm slightly confused. The vertical axis.
yeah, thank you. Yes. So it's because we're not showing enough significant digits. It's I'll read up. It's from 0. It's 0.005. So it's 0.005.
Yeah,
It's 0.015, and then it's
Where is that?
The left hand.
the left-hand
You're
axis.
talking about okay, he's confused because you're doing the left-hand axis on the top thing. What do you think?
So the
No. I think John's reading John, you're reading the bottom.
Sorry.
Yeah.
Yeah. So it's 0.5%, 1%, 1.5%, 2% as the grid lines go up. Does that make sense? It's just rounding, and we're not showing enough significant digits.
Got it.
You got it?
But before we go there, I'd like to look at the top half of that same page, because there's a lot of discussion about extending duration in the face of very low rates in the 2016 study.
Right.
Today we're lower.
By between, let's say, 1.25% and 1.5%. At this point.
And so I know the same issue is on the table, which is, does it make sense? And it's a pretty straightforward question. Does it make sense to own relatively long duration bonds in an environment where rates are so low by historical standards? And does the benefit of diversification offset the risk of rising rates and the cost of rising rates? And I don't know if Mike and Miles, you want to contribute to that?
So yeah, I do have a question. So I think the principal argument for including long duration treasuries is to limit drawdown risk if we do have a big sell-off in the equity markets. My own view, and I'm not the student of the policy-making apparatus that Mike is that if you were to consider all the possible future paths of interest rates from here, there may be an asymmetry. In other words, no one's voiced this as official policy, but if you thought the U.S. was less likely to ever see negative interest rates on U.S. government bonds, does that argue that the correlation assumption embedded in your analysis in 2016 should be adjusted, i.e., at this level of low interest rates, if there was a thought that U.S. rates are less likely to go negative than the rest of the world, would that argue that negative correlation, which is really behind the allocation to U.S. Treasuries, is less likely to persist at today's level of rates than it was in 2016? It's unknowable, but I think that's a question.
Right. And Joe's going to respond as well, but I will say from a perspective which isn't as deep into the mechanics of the markets, I think we are in an anomalous position. We are in a very unusual state of the FIC world where I think the figure is over a third of investment grade bonds are trading at negative yields. It's, so what do you do in that situation? And I do think that we make some correlation assumptions. We also allow for correlations to change and do a lot of Monte Carlo simulation. But we wouldn't invest in long bonds if we didn't think that they diversified the equity risk. The problem, fundamentally, the problem is when you have 67% of a portfolio invested in equity-linked assets, whether they're public or private, that is contributing something like 90% of the risk of your portfolio. It's not equal to the capital allocation because stocks are so much more volatile than bonds. So what do you do? What do you do to protect yourself? And you are remembering that you are a long-term investor, and you can withstand a lot of volatility, you can withstand illiquidity, you can withstand drawdowns. But nonetheless, you are making ongoing contributions to the pension fund. There are a lot of constituencies that are watching the returns of the pension fund. And so you don't just close the door on the fund and say, we'll be back in 20 years and look at the numbers. We're looking at the numbers every month, every quarter, and contributions are being calculated using annual numbers. So we have to be somewhat mindful of the need to protect in extreme equity markets because we are vulnerable to extreme equity markets. The beauty of long bonds is that they're very capital efficient. Unlike buying insurance, they will pay you, as long as we don't go into negative rate territory, they will pay you to own them. You get a positive carry, you're paid interest. They are capital efficient because you can allocate a relatively small percentage of your capital and buy a lot of duration. So they will be, if they diversify, they will diversify in a very powerful way, much more powerfully than intermediate government bonds. That has to be weighed against the risk that we will fairly rapidly move to a more normal interest rate environment, and so you'll suffer price declines on that portion of your portfolio. And that's why there is this debate, because there is logic on both sides. Where we come down on that judgment call, and it really is a judgment call, is that we are very mindful that historical statistics and financial market behavior may in fact be different this time because we are in uncharted territory. However, and we think that you should continue to invest in whatever diversifying asset classes you can, and that includes infrastructure, that includes real estate, which are less equity linked than all of your other non-fixed income holdings. We still continue to believe that long bonds are sufficiently likely to play a diversifying role in the event of significant equity market downturns, such that the potential benefit offsets the potential risk of price declines on that portion of your portfolio.
Yeah, and I think, and so there's make no mistake about any of this, that regardless of what fixed income, investment grade fixed income you put in the portfolio, which is called 17% of the portfolio, that is not the part of the portfolio that is there to generate returns really over the long term. The equity portfolio, Robin mentioned infrastructure, real estate, private equity, those asset classes are intended, that they're allocated to for long-term return potential. Fixed income plays a different role. We listed some of the possible objectives of fixed income. In fact, if you look at page 4, you can see that for regardless of what investment grade fixed income you invest in, the yield is quite low. So it's not as if long treasuries are unique in this way today versus the credit index, investment grade credit index, which has a yield of 2.74. A whopping yield of 2.74, which is the biggest number on the page. The aggregate, which is widely understood as the full bond market, all investment grade securities, mortgages, credit, treasuries. So you're not investing in it for total return over the long term. You get some modest return, and I think, Miles, we agree that the base case over the next, if you call it 5 or more years, 5 to 10 years, is that we end up with yields above where they are today, and it's probably a skewed distribution to the upside. What we don't know is, what does the path look like over the next 5 years to get there? Could we end up with rates falling 100 basis points between now and then? And what does that environment look like for, if we have a 10-year treasury that's at 50 basis points, not 160 basis points? So more than 1% below where it is now. Plausible, and no one thought it was, 10 years ago, but now clearly.
3 years ago.
Yeah, but clearly it is now. I'm not sure exactly what that environment looks like for equities, but it doesn't feel like it's one where equities are going to be generating great returns. And in that environment, long treasuries offer one of the only safe havens in a portfolio. And not only these other investment grade fixed income asset classes arrayed on this page would also do okay, but long treasuries would be the best counterbalance to what equity portfolio security or equity securities are likely to be doing in that environment. If the base case is realized over the next 5 years, and it's done, and it is realized in a very steady way over the next 5 years, where rates just gradually increase, we re-enter a more normal, what people might call maybe the old normal, not the new normal, economic environment where there's real economic growth is closer to 3% than 1.5 or 2. Then that's probably a great environment for equity markets because, broadly speaking, people think, economic growth will be slow for a long time, not only outside the U.S., but even in the U.S., lower than what we've seen for a long time. So that's an environment where bonds and long treasuries won't do well, but most everything else you own is probably doing okay. If not just okay, maybe even better than that. So that's the message. That's what we've been, and for the last 10 years, as we've been, recommending clients consider long treasuries, not every client is invested. We've almost, for that entire time, thought that the base case is that rates would end up higher than where we started, and people would look at us cross-eyed and say, "Well, you think rates are going up, yet you're saying," and we'd say, "Well, we just don't know where rates end up. We might have a base case, but we're not allocating to this for our base case. We're allocating to this for an environment which is very much below expectations in terms of our base case." So I'll just pause and see if there's any other questions, thoughts that people want us to take away from this discussion as we continue to work through the asset allocation with BAM.
Yeah, there are many more discussions that focus on fixed income other than duration. There's also what should the allocation to mortgage, to credit be, but by far the most important decision is what duration should this portfolio be targeted towards, and how you move towards that. So there will be more to come.
John has a question or
Did you have a
comment.
question, John?
Yeah. So when we had this discussion 3 years ago, I remember Scott Evans, the former CIO, saying that comparing this to insurance, which he just did too, and said this is much more capital efficient than insurance. And my understanding of, and really basic understanding, and I'd like to know if I'm correct, and probably not, is that one of the reasons we didn't get to the target duration, which was 18, and I believe now we're like around 12. Is that about right?
Mike would know.
Do you know where our current duration is?
Measure it as the core, as all three sleeves of it: treasuries, mortgages, and investment grade. Teachers is something like 75% of where what the target was set in 16. So the exact numbers I don't quite remember, but it's less than 12 to 18. It's more like 10 to 12.
Okay.
For our portfolio.
And my understanding was that one of the reasons was that the price of getting to that target duration became too expensive. In other words, when you're buying insurance, you have to decide whether the insurance is worth the cost of the premiums, essentially. And I feel like, given what the interest rate, the actual behavior was, as opposed to the expected behavior, we decided that it was too expensive to go all the way to the target duration. So, first of all, is that an accurate understanding? And I'm not sure to which side of the table I'm directing the question.
I'll take it because that was a tactical tilt that BAM did on behalf of all 5 systems. So we methodically put out a plan to get this done over a 2-year time period. About a year into it, we achieved 50% of it. And then we had the election, the fiscal stimulus, and what became call it a neutral yield environment, quickly shifted to a rising yield environment. So what this on top of page 5 shows is a point in time at 4 different times, all consistent times. I'm not accusing them of doing anything in the chart, but there was a lot of volatility in between. So from late 16 all the way probably to November of 18, we're in a rising yield environment, maybe with the exception of the 30-year. So because of that, we paused. And then in early 19, recognizing the changes that Joe had enunciated, we did a pretty meaningful duration extension at that time on behalf of all 5 systems, and we extended from 2s to 10s. So the duration target on the Treasury portfolio TRS is 30s. So we changed our tilt from being short duration to, I'm going to call it more neutralish, but with the view that 10s, 30s, that yield curve itself is going to steepen at a greater pace when 30-year yields are going to drop. There's a whole bunch of nuance behind that view that I don't want to, I'm happy to go into it if people want to hear it. But I think we saved hundreds of basis points by delaying that duration extension and doing it later than doing it if we methodically followed our plan. If that makes sense.
I don't want to speak for anybody else. It makes some sense, but I'm not totally there. But I don't think this is the right forum for you to get me totally there. So,
But I think the answer is yes. I think they felt that the cost in terms of price risk was too great.
okay.
Right?
And the corollary to that is, I mean, paying to a higher price is the same thing as saying you're investing at too low a yield, right? They're identical.
But
They
you
mean
got
the same
basis.
thing, but they are.
But part of the issue you're saying is that the yield is secondary here. That the primary objective is to create the diversification in order to create insulate the portfolio from a drop in the equity market.
To some extent, yes.
It is strategy. Again, I think in our discussions with BAM, I think we all agreed on this. It is strategy first. So, is this the right strategy? Meaning, something you want to generally hold for the next 10 years. But then importantly, and we have some words in here which refer to this. Being aware of the market environment as you move from one position to another, meaning as you move from, let's say, intermediate bonds to long bonds, you're buying and selling securities, so it's important to understand what the market environment is like as you're doing that and executing. And BAM was trying to do exactly that. So it's prudent to do that. It's not just to say we don't want to be sitting here in 10 years and not having executed on the strategy we want to own for 10 years.
So one more question about that. We're talking about sort of filling the portfolio with durations. But as I recall, part of the rationale here is that in 2008, when all correlations went to 1, the exception to that was long duration treasuries, right? But it also then, once the market bottomed out and started to rise again, then treasuries, long duration treasuries, then again diversified, but you didn't want to hold them at that point. And of course, now we know when the market bottomed out, but at the time we didn't know when the market bottomed out. And so, how do you, in other words, you create this this risk diversifier, but then the risk diversifier quickly becomes a sort of I don't know what the right term is, like a weight.
Yes.
Weighing the portfolio down.
That's the price of diversification. So if you knew in advance which asset class was going to outperform, you'd only hold that.
Right.
You would never diversify. But I'm not being flippant. I think that's exactly right. And that's why it's important, if we continue the strategy that was agreed on in 2016, which is to hold some portion of the fixed income program in long duration, it will not have been a mistake to do that if equity markets continue to do well and fixed income rates rally. If we lose money on the long bond portfolio, that doesn't mean that decision was a mistake, because we're making decisions about a huge portfolio in the face of huge levels of uncertainty. I think particularly today, because of the existence of these, of the fact that we've been in the longest bull market ever. We're seeing negative interest rates. There's a lot of geopolitical stuff going on. So it's a very difficult set of decisions to make, and the argument for diversification can be made in a very complex way, but at its simplest, at its hardest, we don't know what's going to happen. We think over long periods of time, over the planning horizon, equities will continue to provide the kinds of returns that we want to see in the portfolio, and fixed income won't, which is why most of our money is in equity-linked securities. But we understand that there's a real risk that over the planning horizon, equities will have a very bad experience. And the best diversifier that we know of against that risk is long governments.
And there are always cash needs for a pension fund, which I think we could all list off what those are. It could be funding, commitments to private investments. It could be paying benefits to your participants. All the things you need cash for. It's always nice to have something that's done really well that you can sell in a liquid market, like a long treasury, in a market like the operating needs of the fund don't stop in the 2008 when just because the markets are doing badly, you can't ask your participants if they can hold off on the checks that they're counting on. So, okay, it's great. We can actually go to the treasury market and actually sell the things that have been up 15, 20, 30, whatever it is in that kind of environment. It's wonderful to have assets. So there's this operational benefit to having assets which perform. And then, then there's a recovery in the equity market after the market bottomed out in the financial crisis. And yes, treasuries are no longer what you would go to source liquidity. Now you have equity markets which are doing well, and you can use those assets as a source of liquidity for whatever needs you have in the pension fund. So there's these daily, monthly, weekly needs that you have, which are critical to the running of this system. And we think long treasuries over the long term can help with that a great deal. And we've seen it with other clients, where we have long treasuries in the portfolio. We've been rebalancing, helping clients rebalance their portfolios throughout the last couple of years, even longer than that. But I see as the rebalancing activity is happening, just to stay near your target, what we're selling one month, we're buying the next, and vice versa. So it's working. The markets are working the way you would generally think they will work, which is not everything's doing well at once, and particularly long bonds and equities, have inverse correlation. Not always, but Michael, yes.
Let me just address the correlation, because that's the crux of what we're dependent upon. What we depended upon before, correlation ended up being positive. So it worked out well for us for the wrong reasons. But during those periods when equities had bad days, weeks, months, quarters, sometimes it worked, sometimes it didn't. By the end of the reporting period, it has. So it begs the question: what do we think going forward? And I think Robin laid it out well. We don't know. It begs the question: why has it worked over the past 3 years? Why the past 10 years? I think Dave can answer my question for me. By 12 trillion or something, you're going to change the price. So to my mind, and I showed you at the sim a chart of long yields going back to the founding of our country. We've never been this. Our country's been through a lot of stuff. So why now? Is it that bad? Yeah, it might be. It might be. The level of debt in the country is so high that the future might be that bleak. But then that begs the question: is that negative correlation going to hold? And I want to offer the other side of the argument, not that necessarily I believe that, but just so you hear two-sided. Why are our rates so low now, long rates so low now? I would argue because what's going on in global bond markets. So of the 17 trillion of negative yielding bonds, 40% is Japan, 60% is in Europe. In Japan, the funds rate, our funds rate here is, what is our funds rate now? 1.875? The midpoint?
Yeah.
1.875. In Japan, it's minus 10. Our QE program was something like, correct me if I get these wrong, 17% of GDP, and Japan's is 45% of GDP. So Japan's bought all the bonds. The government bought all their bonds. The 10-year yield's minus 20, I think. So that adds to that. In Europe, the funds rate is minus 50. They announced a new QE program a month ago. They don't have enough bonds.
Mike, just to make clear, basis points.
Yes,
Minus 20 basis points.
Yeah, minus 0.5.
Don't go by our scale.
but it's crazy to as Joe laid out, that you're going to lend the Swiss government money, you're going to get back 99 cents on the dollar. Like, why would you do that? Why not stick in the mattress and get 100? So to me, what's driven long rates low has been foreign bond markets by foreign economies. Is that going to continue? Don't know. Can they buy 12 trillion of debt over the next 10 years? They can't. There's not that much debt to buy. So if this monetary policy is not going to work, what's next? Fiscal policy. So there's a likely outcome that the next wave of stimulus is fiscal policy, and that's pro-growth. That's more borrowing. So it works against fixed income in both directions, and that concerns me. So I think that's the other side of it, and I think what's really important is that we don't know what that negative correlation is going to be. So I looked at, I think you guys have minus 0.04 on a big picture scale, but they've also been very clear. It's not that long one. It's what we call the left tail. In an adverse environment, that's when it's really going to help you. It has. Will it continue? If you look at our yields relative to the globe, we still have room to come down. But I would argue we're already down because of that. The policymakers have been pretty clear they don't intend to go to negative rates, but best intentions are what they are. But they will do more QE if they can, and that would drive long rates lower, and that would be helpful. So that's just kind of the other side of the argument. It's like we're dependent on that to work in a negative, in a bad situation, and we don't know.
So there you are. Is that
I'm during a presentation, I think that ends. We don't know. The press going forward.
And when do you buy insurance? When you don't know. So just to end on
On a positive,
Rob in the last word.
So really more to come. Right now, your target allocation does include this long bond exposure, and we'll be looking at scenarios in which that is maintained, which that isn't maintained. So we'll be back with other decisions that will need to be made, including how to allocate across global equity markets, how to allocate to mortgages, credit bonds, which you will continue to own at sort of market duration, and how to allocate to the private market strategies.
And I'll just add on that, not to get into some of the things, particulars, but where we have been very closely aligned with the broker time is to de-risk your portfolio and to reduce the equity beta in your portfolio. So we're looking to get more diversification and less exposure to the U.S. equity.
Any more questions? Thank you.
Yeah, thank you, Rob, and thank you, Joe. Is there anything else before we? Okay. Do I have a motion to move into executive session?
Sure. I move pursuant to Public Officers Law, Section 105, to go into executive session for discussions on specific investment matters.
Thank you, Mr. Brown. Is there a second?
Second.
Thank you, Mr. Kazansky. Any discussion? All in favor?
Aye.
Any opposed? All right, we are in executive session. Okay, welcome back to public session. Susan, will you report to us?
Yes, okay. In executive session, we received proposals from two vendors. Consensus was reached as to the next steps. We discussed a specific manager within the variable A program. Consensus was reached, which will be announced at the appropriate time. There was a presentation on 2 previously approved investments within the pension fund. Consensus was reached on 1 of the 2.
Thank you. Is there anything else that anyone like to add? Okay, do I have a motion to
Before we
adjourn?
adjourn, I'd like to invite all of you to join David and me in wishing our Madam Chair a very happy birthday today.
And you're younger. There you go. Thank you. Do I have a motion to adjourn?
So moved.
Thank you. Do I have a second?
Second.
So,
No.
thank you, Natalie. All in favor? Aye.
Aye.
Any opposed? Okay, we are adjourned.